attendees. One of the new normals is that we are all bombarded by numerous invitations for webinars. So thank you very much for spending your valuable time with us. One positive consequence of the pandemic is that we have become more comfortable with web-based conferencing. Without that, I'm not sure we would have been able to organize an event like this with such a wide array of voices from around the world. Last but not least, I'd like to welcome our panel of international experts. Thanks for investing your significant time to share your insights. So I'm going to start the slideshow now. All right, sorry, I think the slideshow is already up. So what are we going to be talking about today? So it goes without saying that the pandemic has caused enormous change throughout the world and has had a significant impact on litigation, arbitration, and dispute resolution generally. At the start of the pandemic, many of us had predictions of how it would impact our clients. It's now approximately 9 months following the start of the economic impact of the virus in February 2020. So it's a good time to take stock regarding what we can now say with more certainty about how it's impacting quantum and loss and damage assessments. Today we have a panel of some of FTI's top experts from around the world who are involved in quantum and loss and damage assessments. So who will you be hearing from today? I'll let each of the experts tell you a little bit about themselves and their own specialty, but I'll give you a brief overview of each person. Donna Wright leads FTI's Forensic and Litigation Consulting segment in Australia. She's based in Melbourne. James Nicholson is head of FTI's Economic and Financial Consulting practice covering Asia and is based in Singapore. Steve Harris leads FTI's economics practice in the Middle East and is based in Dubai. Alex Davey is a senior managing director in our economics team in London. And back again to Australia, Stephen Ray is the senior managing director in our Perth office. All of the experts on the panel are expert witnesses specializing in economic loss and damage quantification, business valuations, or forensic accounting, with the exception of Stephen Ray, who is an expert witness but is also a chartered quantity surveyor focusing on quantum and delay with regards to international construction projects. Now, I won't steal the panel's thunder, but for context, some of the interesting issues they will be discussing include hindsight, market volatility, prevalence of wider disagreements between experts, dates of loss, industry and geography specific impacts, and winners and losers with respect to commercial disputes and construction claims. Now we're going to start with Alex Davey in London to provide his insights from the matters he has been working on throughout Europe. Take it away, Alex.
Morning, everyone, from a dark and gloomy London. Thanks, John Henry. I'm Alex Davey. I focus on business valuation in the context of disputes or transactions and restructurings. And I'm going to talk a little bit about how certain we can be about the value of businesses given the COVID crisis. And to do that, I'm going to give some context with a very short explanation of the principles of business valuation. If you go to the first slide, please, John Henry. Most valuation methods start with the assumption that the value of a business is a function of its expected future profits or cash flows. So, for example, under the commonly used market multiples approach, we make a projection for 1 year's profits of the business we're valuing, and we multiply those profits by a valuation multiple that should reflect the growth that that business is expected to achieve and the risk to which it is exposed. So if we know that a business with a comparable risk and growth profile to the one we're valuing was sold for $10 million last year and made $1 million of profit, we can say that it was sold at a 10 times multiple. And if we apply that 10 times multiple to the $5 million of profits that the business we are valuing has made in the same year, we can say that that business is worth $50 million. Now, what that means, as the slide shows, is that to value a business, we need to form a view as to the profits the business we're valuing is going to make. And we also have to form a view about how they will grow and how risky those profits are. And then you need to find an investment with similar characteristics as to risk and growth, whose price we can use to anchor our valuation. Now, in March 2020, when the COVID crisis hit, all of those tasks have become a bit harder. So by way of example, imagine you're valuing a hotel company. In March and April of this year, hotels around the world were generally shut, and it wasn't clear how long they were going to be shut for. So forming a view as to what 2020 profits were going to be became very difficult. And it's difficult to assess how things like the shift to Zoom meetings and the fact that people are happy to attend webinars instead of seminars have affected the growth profile and the riskiness of will affect the growth profile and riskiness of hotel profits in years to come. So does that mean that valuation has become an impossible task in the COVID crisis? Well, happily not, because even in normal times, the future is uncertain, and valuers have to deal with that uncertainty, and they do that by looking to financial markets for how that risk is priced. And throughout this crisis, and this doesn't happen in every crisis, but throughout this crisis, major markets have, by and large, continued to operate and to price risk for us. So imagine, for example, that the hotel company we're trying to value is Hilton. Now, Hilton's shares are traded on the New York Stock Exchange, and the price at which they are traded is published. And what that means is that even though it's hard to know what the future holds for Hilton, we can say with some certainty what the share in Hilton is worth. So actually, it turns out that the increased uncertainty about the future that the COVID crisis has caused is only part of the difficulty that's arisen for valuers. In my view, the bigger challenge that has come about is the increased difficulty in finding benchmarks in the market by which we can anchor our valuations on. And I'm going to illustrate that with a couple of points again from the hotel industry. Now, as I mentioned earlier, when we're looking to value a business, we need to find a valuation multiple from a market transaction, and typically one source of those valuation multiples, of those valuation benchmarks, are transactions which have happened in the past, about companies that have been bought and sold in the past. But in March of this year, the world changed, and that means that those transactions from the past have become much less relevant. John Henry, if you could go on to the next slide, please. What this shows is the earnings multiple at which Hilton's shares have traded since 2014. And hopefully you can see from that slide that that multiple's averaged around 25 times since 2014. And generally it's been in a range of somewhere between 15 times and 35 times. But what you can also see is that today it's at 55 times. And what that means, what this illustrates, I hope, is that valuers need to be very careful about using benchmarks about valuation that arose before the COVID crisis, and that therefore limits benchmarks available to us, and that makes valuation that much harder. Another difficulty that the crisis has had on finding valuation benchmarks is that it's had a very different impact in different geographies and different industries, which again further limits our pool of benchmarks we can use when doing a valuation. John Henry, if you go to the next slide, please. Imagine for a moment you're valuing a Chinese hotel company. Now, normally, when you're doing that, you might look at multiples hotel companies around the world are trading at and being bought and sold at. This chart shows RevPAR, revenue per available room, which is a measure of hotel yields, and it shows those yields across the world in different regions in 2020. And you can see from this slide that Chinese RevPAR fell first, and it fell very steeply back in February of 2020. But then since then has gradually recovered as movement has restarted in China, as hotels have reopened, such that now it's about 90% of where it was in 2019. Now compare that to the US, where RevPAR is at 50% of 2019 levels, or France, where it's at 25%. what that means is that if you're trying to value a hotel company by reference to international peers, you need to be really careful to make sure that the hotel company you're looking at is at the same place in that cycle as the company you're taking your valuation multiple from. So where does that leave us? The task of valuation certainly got harder, and that's largely because it's become harder to find market prices from which we can extrapolate to the value of the asset we're interested in. And that does mean that for some assets, it's going to be harder to arrive at firm conclusions about valuation. But it's important to remember that financial markets have continued to function throughout the crisis. And in fact, M&A is continuing to take place at quite a pace at the moment. And that means that, as ever, the most reliable valuations are going to be those that are rooted in market evidence. With that, back to you, John Henry. Thank you.
Great. Thanks, Alex. The next speaker is going to be Donna Wright from Melbourne. Take it away, Donna. I think you're on mute, Donna.
Yes, I'm just, sorry, a bit slow off the mark there, sorry. Hi, everyone. My name's Donna Wright. I lead the forensic practice here in Australia. I specialise in economic loss and damages. I have more of an accounting and auditing background and now specialise in economic loss, mostly litigation and arbitration tribunals. So I'm actually just going to demonstrate a couple of the concepts that Alex just spoke about and that John Henry referred to at the start, by way of a couple of quick examples of some of the matters we've been working on this year that have included some of those issues. John Henry, can you perhaps just go straight to the first one? So I'm going to just jump straight in. This one is actually not so much a valuation, but just an economic loss assessment. And it demonstrates one of the topics that John Henry mentioned, which is depending on what your loss state is, it might be increasingly difficult to separate out losses due to an event compared with losses due to COVID. This one was where we were asked to quantify losses that occurred due to a cyber event. The cyber event impacted warehousing and logistics, and therefore retail stores weren't able to sell their products immediately following the event. And quantifying the loss from that was pretty easy. As you can see from the slide, right after the incident, there was sort of a noticeable drop in this is just measuring revenue, but in revenue and profit immediately after the cyber event. And we could see that compared to the experience from the prior years. But about 4 weeks later, before the business had recovered, we had the first lockdown in Australia when all non-essential services were forbidden, including retail. And so from that point on, there still is highly likely to be a loss from both the cyber incident as well as from COVID. But obviously trying to parse that out as to which is which is a lot more work. So for this purpose, we were actually doing a fairly preliminary assessment for the purpose of a negotiation immediately following the breach. Has not yet been resolved, and there will be a significantly greater degree of complexity in trying to dissociate the losses from the cyber incident from the losses due to COVID going forward for the period after. Next slide, please, John Henry. This one, the second example is following on from Alex's example, where this is a completely different industry, but a slightly similar pattern of share price that we were just looking at with Alex a few minutes ago. This one is in Australia. It was an auto body, a roll-up of auto body repair shops. So it's a publicly listed company. This is the share price of the purchaser. And what we were asked to do is quantify the loss due to a failed transaction. So there was this public company was meant to acquire some local businesses in about November last year. The transaction didn't complete. We were jointly appointed by the parties to answer these questions, so more in a single expert type of role. So we don't get a lot of the flavor behind the scenes when we're doing that role because we have very limited communication. So we don't know the reason that the transaction didn't complete, but what we know is the parties are before a court contemplating whether the transaction should be compelled to go ahead, but a year later, which would be this October or November, or whether it doesn't go ahead at all. And so that's the question before the court that we're being asked to assist with. But the questions that we were asked had an interesting sort of interaction with the timing. So we were asked to quantify loss to the vendor from the transaction not going ahead. And what we actually found was the vendor is probably better off from the transaction being delayed because it had a fixed price plus an earnout component. And the fixed price obviously stays the same whether the transaction completes last year or this year. But we found that the earnout component would probably not have been achieved, or highly unlikely to have been achieved, if the transaction had gone ahead last year, and much more likely to be achieved if it goes ahead this year. That earnout was about 30% of the total consideration, so it makes a significant difference. We were also asked about the financial performance of the business over that intervening time. The business suffered losses, but the difference in the earnout was more than enough to make up for the losses suffered over the trading losses suffered during the year. And finally, we were asked about the value of the business at the different dates, which is where it links back to Alex's point. In theory, the business is the same. It has the same potential and the same long-term outlook. But when we're matching it up to comparables at different valuation dates, that can have a significant impact on the calculated value. So because our role is to assist the court in this case, as opposed to tribunal, we had to be very clear about assisting the court by making it clear that the valuation date that they asked us to adopt has a significant impact on how we could quantify a value. And we were asked to do the value at the date of our report, which was the 31st of October, but we're only provided financial information from August. And even between August and October, there was a significant improvement as New South Wales came out of lockdowns. And we could see that, you can see from even beyond the date of our report, the shares price and the values assessed in the market are continuing to increase. So in that case, it was a question of being very clear and transparent so that the court would be able to use our opinion however it decides is the most appropriate, especially given that a decision might not actually be made until the court makes its decision, which could be months from now, and a very different view at that point as well. Thanks, John Henry.
Thanks, Donna. So next we're going to hear from Steve Harris in Dubai.
Hi, thank you, John Henry. I also specialise in damages assessment. I've been with FTI for the past 12 years and in the UAE since late 2013. So in damages assessments, we're often required to project how businesses would have performed had an alleged contractual breach not occurred. And one naturally thinks about the sales revenue a business would have earned. And as I think, Donna just touched on, if a breach has occurred this year, projecting revenue is likely to be more complicated. And that's because COVID has affected demand for lots of products and services in unexpected and extreme ways. And indeed, restrictions have been imposed upon, suppliers and companies in terms of provide those goods and services. I'd also like to focus on another aspect of preparing financial projections, which may not come to mind as naturally, and that's thinking about the supply chain. And timing and location can also be really important here. So if you could go on to my first slide, please, John Henry. So here there's an analysis of COVID cases globally, broken down by continent. And for the audience, I apologize that Oceania, Australasia is not shown separately. And look, the reason for that is that the number of cases is comparatively just so few in Australia, New Zealand and the surrounding islands that it just doesn't register on a chart like this. But what the chart does show, I think, is that the virus has spread at different rates, considerably different rates in different parts of the world. And as a result, understanding the effect of the virus across a particular point in time, in a particular location, the restrictions that applied, that requires careful thought and analysis. If you could move on to the next slide, please, John Henry. So this is a slide I've lifted from another presentation, and the annotations don't match what I think I'm going to say exactly, but the scenario hopefully still works. So it concerns an alleged breach of supply by supplier A, I've imagined is based in Oman, to manufacturer A, which is based in the UAE. Now, the supply chain is often something that we take for granted in preparing cash flows. One assumes that businesses will be able to purchase the goods and services that they need if they have the money to do so. In this case, what's the situation if supplier B in South Africa, let's say, was unable to supply key products in the manufacturing process at the same time as the alleged breach by supplier A? This could reduce the financial consequences of the alleged breach. Manufacturer A wouldn't have been able to manufacture goods anyway. On the other hand, if manufacturer A's main competitor was based, in China, sourced its raw materials in China, it could have been the case that during the period when supplier A breached the contract, the Chinese competitor was prevented from manufacturing also. So but for the breach in those circumstances, manufacturer A could have sold to its existing clients, and it could have sold to clients who would normally have purchased products from its main competitor, and this could increase damages. So, I guess my overall point is that for short-term forecasts, which cover the period when the pandemic's been spreading, preparing cash flow forecasts is undoubtedly more complicated than it would have been absent the pandemic. I don't think it necessarily follows that damages will always be lower, but it does mean that experts need to work harder to ensure that forecasts are robust. I'm also briefly going to touch on challenges with long-term forecasts. And I think, again, it's industry and it's location specific. Alex discussed the hospitality industry, clearly an industry that's been massively affected in the past year by the pandemic. And I've seen research papers that have suggested that industry, that market, will not recover until 2025. That's a long time. We've also seen a large fall in the oil price this year, that's coincided with the pandemic. I've got a graph of this on the next slide, John Henry. And of course, a sustained low oil price will obviously affect damages for disputes which relate directly to oil and gas industries. But in the region where I'm based, in the GCC, it will also affect assumptions about long-term economic growth. And this is because in this part of the world, growth is very much driven by government expenditure, and that's very much driven by oil and gas revenues. But again, it's nuanced, right? As on the one hand, intuitively, one would expect government expenditure to fall due to low oil prices. But on the other hand, I think we're also likely to see governments in this region accelerate efforts to diversify their economies and reduce dependence on oil exports. So there's obviously a lot more that one could say about these issues, but hopefully I've just about kept to my allotted time and given a flavour of some of the relevant considerations.
You've done very well on time, Steve. Thank you very much. Next, we're going to hear from James Nicholson, who is in Singapore.
Thank you, John Henry, and hello to everyone. Thank you for joining us. Thank you to Akika for having us, and we hope you found it interesting so far. I am going to pick up on something that Donna has touched on and go a little deeper on it, which is also a key aspect of the framing of a damages claim, which is choosing at what date to assess a loss. And that's always an important topic, but it's particularly an important topic now with COVID, as we've had in 2019, just as it was back in 2008, 9, 10, 11 around the global financial crisis, and similar considerations were in play then as they are now. So just to explain the relevance of this, so damages are typically framed as comparing the financial position a claimant would have been in but for the alleged breach or wrong, whatever it might be, compared to the situation that they are actually in. And we as damages experts find ways of placing a value on the position a claimant was in both but for the breach and in actuality. Now you might think when constructing that scenario that the way to do it is to look at the state of the world as it is at the moment that you're doing the analysis, so as of today or a current date. So that would imply using all the knowledge that one has as to what's happened since the breach, and also basing the loss assessment to the extent there are losses arising after the current date on expectations of the future as of the current date. And that's known as a current date assessment of losses. And that's certainly one way that losses can be expressed. They often there's a couple of things to say about that, though. So I'll talk about an example in the oil and gas industry. So this relates to a very large case that we've been working on over the last couple of years in the oil and gas industry, relating to effectively an alleged expropriation of an upstream oil and gas asset in APAC. The field was in an advanced stage of development. The claim was filed in 2018, and the claimants decided to frame their claim based on the value of the asset as of the current date, as it then was. Implication of doing that is that as time passes, you might need to update your quantification of losses for future events. So John Henry, can we have the first slide, please? So Steve's already shown you a version of this. The solid line here is showing Brent crude, so a benchmark for basically global crude oil prices over the last couple of years. And you can see that crude oil prices was sort of averaging somewhere between $65 and $75 per barrel until, in fact, till the beginning of this year. They were beginning to fall from January this year, unrelated to COVID. My memory, I haven't checked this, was that there were the usual OPEC wranglings and increased production, etc. And then you can see the freefall that happened once the COVID pandemic and the reaction to the COVID pandemic took hold in around March, and then prices have come back subsequently. And there's a similar pattern. We've got monthly data for LNG, right, liquefied natural gas prices in Japan over this time, and you can see a similar pattern there, although I don't know quite what the peak in the summer or the spring represents. And so if you're framing your claim as of a current date in 2018 or even 2019, sorry, wasn't ready for that, then you're basing your claim on expectations as of that date as to what your gas field would have been worse, and so you're lashing yourself to a mast in a sense, because you're tied to evolution of oil and gas prices over time in this example. So now, John Henry, you can see the effect of being lashed to that mast and how you feel in spring, summer of 2020 when you see what's happened to prices. The value of your claim falls quite significantly, and you're unhappy in this situation. This would have had a major effect on the quantification of loss in this case. In fact, we didn't update our quantification of loss in this case because the parties came to a settlement, and as is typical for us as damages experts, we weren't privy to those settlement discussions, but we imagine that the dramatic moves in oil prices and gas prices were a factor in that settlement. The underlying point from this example is that if you use a current date, that introduces risk to your assessment. Of course, that risk has crystallized in a major negative way this year. In other circumstances, that risk could crystallize in a positive way. And of course, the nature of a risk is you don't know which way it's going to go. So that's something that you have to be aware of when you're framing your loss based on a current date of assessment. And that's true even in less volatile periods, as perhaps this period, as perhaps 2020 would have seemed from the point of view of 2019. So if we want to avoid these difficulties of lashing ourselves to the mast of future developments over the life of a dispute, is there a different approach? Well, there is. Many of you will have seen that. And under some jurisdictions, it's necessary to claim losses as of the date of the breach rather than as of a current date. So that means assessing losses as of the date the breach happened, based on knowledge as of that date and expectations as of that date, and then adding interest to bring whatever value you come to as of that date up to the present. Since most claims are filed, what, six or 12 months after the alleged breach, and many arbitrations at least run for 18 months, that means that by the time of the award, your quantification of losses is based on expectations and knowledge that's at least 2 years old. And for us as valuers, we just accept that as a logical consequence of using a past date. When you're doing a valuation, you need to know the date at which you're doing your valuation, and then you take no direct account, certainly, of hindsight, and only in limited circumstances, indirect account of hindsight when you're performing that loss. So to consider another example, consider now a tourist development. And this parallels another case that we're involved in at the moment. So there's a breach in 2016 which effectively, again, expropriated this tourist development before it was completed. The development would have launched in 2018, and if the development had gone ahead, then next slide, please, John Henry, you hit 2020. So I'm here using Singapore monthly hotel occupancy as a proxy for the regional tourism industry, partly because there's good monthly data available in Singapore, Singapore being Singapore, so that's a useful way of looking at it. And again, as you would expect, the tourism industry, the travel industry, is hit very hard in 2020. So a valuer would say, if you're asking me to assess the value of this asset in 2016, the date of the alleged breach, then really I'm not going to take account of subsequent events. And so the fact that the industry's had a very, very difficult 2020 doesn't come into it. But it remains a fact that the claimant would have run off a cliff in 2020 but for the breaches. Next slide, please, John Henry. And here you see the claimant running off the cliff. And here you see the tribunal watching the claimant running off the cliff. And the question is, or at least one question is, will the tribunal be able, willing, or even allowed to disregard events that happened after 2016 when the world changes so dramatically for a business, a project such as this? And that's key to assessing where any quantum award will come out for obvious reasons. And it may be hard for tribunals to disregard, partly because, as I understand it, the law under some jurisdictions allows or even requires a tribunal or a court to take into account dramatic subsequent changes to the context, the environment of an investment. But also, even if that's not the case, then tribunals are, of course, made up of human beings, and it's hard to cast out of one's mind subsequent events, especially if one side is highlighting those subsequent events, as in this case one would expect a respondent's legal team to be talking a lot in their submissions and probably at the hearing about the nature of the subsequent events and the effect on the value of the investment in actuality. So even if the tribunal decides that's not relevant, it may not be able to put that out of its mind. So So that's one or two of the difficulties of choosing a data breach date for the date of assessment. I think I'm running long. Just very quickly, two final thoughts. Firstly, usually a later date of assessment of loss leads to a higher award. And that's because assets tend to rise in value over time. But with this year's events, if you choose to quantify your loss based on a past date, so a pre-2020 date of assessment, and you apply the hindsight rule strictly, or the no hindsight rule, I should call it strictly, then you may end up with a higher claim than if you use a current date. In fact, in many industries, you're quite likely to. But you're relying on a tribunal or a court putting the subsequent events out of their mind and being allowed to put those subsequent events out of their mind rather than factoring them in your loss assessment. And the final thought is, I've talked about the effect of the date of assessment of loss, choosing your date of assessment of loss. But another issue in all of this that you need to have in mind is collectability. If your counterparty is distressed because of the events of 2020, then however cleverly you frame your loss and however badly you've been damaged, if they just don't have the resources to settle or to pay any award, then you won't get the recovery that you're hoping for. That's me done.
Thanks, James. Next, we're going to talk to Stephen Ray in Perth.
Thank you, John Henry. So my name's Stephen Ray, and I head up the FTI Australia construction practice, and I'm based in Perth. Now, as a construction and quantum and delay specialist, I'm frequently appointed to assist courts and tribunals in determining how much loss or damage a party to a construction contract may have suffered, either as a result of a breach by the other party or as a result of some other event that may have impacted the progress of construction works. You see, on a construction project, time really does equal money. And it would be generally the case that should there be a delay in a construction project, then the contractor will be caused to be on site for a longer duration. And it would follow from that the contractor would be required to pay for its site management and construction resources over a longer duration. A delay of, say, 1 month on a construction project would usually mean that a contractor would have to incur an extra month's costs to complete that project. But it also means that the owner would be denied a month's worth of operational income to be derived from that project upon completion. And in both cases, those costs can be quite substantial. To this end, most construction contracts contain provisions that afford the owner a right to pre-agreed or liquidated damages in the event that a contractor is late in completing the works. And these terms also permit a contractor to claim an extension to that completion date, an extension of time, and in certain cases, additional cost, where a delay has been caused by specified events. And it's often my job to determine the actual impact, if any, that a qualifying event has had on the contractor's planned progress of the construction works and to quantify the financial impact of any resulting delay. Now, I think it's fair to say that the COVID pandemic has had quite a severe impact on construction and engineering projects globally. Disrupted supply chains and the impact of social distancing requirements at project sites have conspired to cause delays and additional costs to construction works. But it might be surprising to learn that in most jurisdictions, and it's certainly the case in Australia, save to the extent provided for expressly by way of the terms of the particular construction contract, then a contractor would generally be held to assume the risk for a COVID type of event. However, most construction contracts do make an attempt to allocate the risk as between the parties a little more equitably. Typically, the effects of COVID on construction projects seem to have manifested themselves in two distinct phases. Firstly, the initial impact of the epidemic on global supply chains and the effect on equipment being delivered to projects. And then secondly, the effect of government directives issued in response to the pandemic and the effect of those directives on construction progress. Now, taking account of construction terms and agreements that are reached between the parties, there are probably two commonly found provisions that are relevant in this case. The first being a force majeure clause, and the second a change in law clause. A force majeure clause ordinarily affords entitlement to an extension of time, but not usually costs, where delays have been caused by specific events as defined by that clause. And they're usually events that are beyond both parties' control. Occasionally they're referred to as acts of God. And it will depend very much on the wording of the clause as to whether or not that force majeure provision would extend to, say, epidemics, and therefore encompass perhaps COVID. And many contracts place the risk of a post-contract change in law with the owner, affording the contractor an entitlement to an extension of time and in some cases additional costs. Now, one project that we've recently been involved in involved a large international contractor that had been engaged to design and construct an industrial engineering project here in Western Australia. Works were at a crucial stage in mid-January 2020 when COVID started to emerge and the effects of it started to emerge in China. Structural steel was being fabricated here in Australia, but key items of equipment were due to be shipped commencing the end of January from China and then subsequently Europe. The project initially suffered from supply chain disruptions from the end of January 2020 in relation to equipment that was due to be shipped out of Wuhan. Further equipment deliveries from Europe were affected during February and March as COVID spread into that region. And then in mid-March 2020, the Western Australia government issued a proclamation under the State of Emergency Act, affecting the way in which works would be undertaken at the site. Now, the lawyers advised that the initial supply chain disruptions were most likely to be covered by the force majeure clause under this particular contract, and ostensibly entitled the contractor to an extension of time. They also advised that the state of emergency proclamation constituted a change of law under this particular contract, which afforded the contractor entitlement to time and costs. So with all of this in mind, we conducted a detailed forensic analysis of the planned versus actual progress prior to and during the period in which these events occurred. So John Henry, if you wouldn't mind going to the case study slide, the next slide, please. Thank you. So the top portion of this slide shows the status of the project as at the 25th of January 2020, immediately prior to the COVID disruptions taking effect. And the bottom portion shows how things progressed during the period of equipment delivery delays and following the state of emergency proclamation. Our analysis concluded that the equipment shipping delays actually had no effect on completion. And this is because, in effect, there was float or spare time available between when the equipment was planned to be delivered and when it was required to be installed. And the shipping delay merely consumed this available float without impacting the overall project. However, the changes under the State of Emergency Act did cause a 2-month delay for which the contractor was entitled to an extension of time and reimbursement of additional costs incurred. And having arrived at these findings, we then proceeded to quantify the additional costs for the 2-month delay based on an analysis of actual cost records over the period in which the delay impacts were being felt. These costs comprised the cost of the loss of labour productivity due to social distancing measures at site, and the cost of prolonged site management and project operational resources. And that's me done. Thank you.
Fantastic. Thank you very much, everybody. That was very educational. And now we're going to open it up to questions. We have about 10 or maybe 13 minutes to take questions. We've already got a couple lined up, so I'll start with those. But anybody who's still online, feel free to type some questions in the box in the chat function. Again, if we do run out of time, feel free to reach out to us afterwards to ask those questions. So the first question relates to date of assessment, which is also tied to hindsight, whether you can use hindsight or not. And so I'll throw this to James. Date of assessment, how's it decided? Is that a matter for the damages expert?
Thanks, John Henry, and thanks, Trevor, for the question that I see in the chat. It's usually a matter of instruction. That instruction often comes after discussion with the expert as to the implications for the damage claim. If there is leeway within the applicable law to argue for different dates. That's particularly true in bilateral investment treaty cases, where claimants often argue that they get to choose the higher, whichever date gives them the higher figure between date of breach and current date. Sometimes the question is put to me, if we didn't give you an instruction, how would you approach this? And in that situation, I refer to the but-for versus actual framework that underlies most damage quantification, and that often that typically gives an approach that can be defended from economic or just purely logical principles. Of course, one as a damages expert isn't expressing a view as a matter of law. So I hope that answers the question.
Yeah, thank you. And we might open it up to anybody else on the panel that has any differences. I've got another question. You know, how do things differ around the world? If things differ related to what James was just talking about, or anything else, feel free to chime in. Okay, so it sounds like it might be similar. Let me throw a question to Donna, actually. So we talked about the differences around the world. We've mentioned a couple different ideas. Donna, you've got a good example of how things might be different, different aspects that you have to consider when you're calculating loss in different countries.
Yeah, excuse me. Yes, thanks, John Henry. I guess it's partly just thinking back to, I think it was Steve's slide that showed the impact of COVID is obviously different in different jurisdictions. But, in Australia, I think we've had some of the lowest cases that wouldn't even register, but we've had some of the strictest lockdown measures. So the impact on businesses is enormous, or would be enormous if it weren't for the measures put in place by the Australian government. And so obviously one difference between countries and jurisdictions, looking at wherever your asset that you're valuing is located, will be the timing of the impact, because it's, as Australia perhaps is now coming out, other places are going back in. So it'll be different in different jurisdictions. And even in Australia, state by state, as we know, where I am in Melbourne, we're still significantly impacted, whereas over where Stephen is in Perth, they've been back to normal for months. So you have to be very careful, I think, when you're looking at the underlying business. But one example where we had the plaintiff was plaintiff's expert, was calculating loss and said, they've ignored the effects of COVID, which I think was meant to sound, quite reasonable and conservative. But when we looked at what was it that they were actually ignoring, it was actually they were ignoring the fact that, the government had been paying the salaries of the employees through the JobKeeper program, which is also saying, in Australia, if your revenue has been below 30% less than where it had been previously, you're eligible for the JobKeeper program, which means the government, you get a large significant government subsidy to pay your wages of your employees. And so if you don't take that into account, you'd find the company's actually better off with COVID measures than it would have been otherwise. So I think you have to, but that measure would be quite specific to Australia, and I imagine different governments around the world are either putting in place different measures or maybe no measures. So again, you can't just take things at face value, and you do have to dig behind the assertions and the numbers and the calculations and see what they're actually, what the COVID factor is actually trying to cover up. In Australia, there's also been significant rent abatements, so many companies haven't paid any rent on their premises for a number of months, and so all of that needs to be factored in. And I'm sure other people might want to answer with what the specific measures are in their part of the world, if any, too. It might be quite different.
Okay, if there's no other comments on that, I will move on to the next question. And so I've got a question about Steve Harris. You had mentioned before, and I think a couple other of the panel members had mentioned that losses because of after COVID or during COVID, losses can sometimes be significantly higher than what they would have been, what they might have been pre-COVID, and sometimes they could be significantly lower. Can you go into that a little bit more?
Yeah, sure, John Henry, thank you. I was also a bit slow on the buzzer when asking to reflect on the previous questions, and I'll say something quickly on date of assessment, if that's all right. Look, I agree with everything James said. I think it often becomes more complicated in, I guess, lost profits claims, where the consequences of the breach are not permanent, right, but exist over a defined period of time, and you may be preparing a report in the middle of that period, or you may be doing the analysis, after that period's over, right? And if you're looking at a data breach assessment of the losses, it can be odd, right, to ignore what actually happened to the business, in the period subsequent to the breach, and that's a challenge that we often work through, with counsel. So look, it's certainly a matter of law, but there are frequently circumstances where it doesn't seem sensible to ignore what's actually happened after the valuation date, I guess, which is a point James made in his presentation as well. Part of my reason for answering that was because the winners and losers question is a hard one. I think there's 2 points maybe. One, I'll answer this. Well, and I guess you could answer it with reference to, if you look at the S&P 500, right, it fell dramatically, when COVID broke out. I think it was like 30% in 8 days or something. It was a quicker fall, in a major index than at the time of the previous, financial crisis in 2008. But it recovered pretty quickly, within 2 or 3 months, I think, to its previous level. And a reason for that is that the market, perceived winners and losers, right, due to the pandemic, right, which changed consumer behaviors and opened up new opportunities for certain firms. And if you look at it, pharmaceutical development firms, tech firms, even, budget stores, I don't know what they call them in America, like, I want to say dime stores, but, home improvement stores, there's a bunch of sectors where, their share prices have increased over the past year, and they've recorded, they've performed very well and better than expectations, right? So that's one reason why losses could conceivably be higher, in the period of the pandemic. And I guess another reason is, if there's a breach pre-COVID that deprived a business of cash, it may well have needed that cash in order to survive, the period of the pandemic, right? So it may be that breach, has caused a business to fail, right? And conceivably the loss could be higher. And I would say, I'm involved in cases currently, where both of those scenarios are in play, and we're working through them.
Steve, I might just follow up on that. I've got a case at the moment where effectively there's an argument about whether damages are higher or lower due to COVID. It's a case involving a dispute between one party who owns a hotel in Greece and another party who was due to manage that hotel. And under the terms of a contract, the manager was supposed to organise for the hotel to be renovated in last winter, so before the onset of the pandemic. Now, turns out that most hotels in Greece have been shut this year for obvious reasons. So that would make you think that actually the damage for the renovation is low, because you wouldn't have been able to get the rate uplift from that renovation this summer anyway. But actually, the claimant makes the argument that if we'd been renovated earlier, we would have secured guaranteed contracts with tour operators prior to the onset of the pandemic. And that means, first of all, we would have got compensation from tour operators. And second, some hotels did open in Greece, and the ones that opened were the ones which had these guaranteed contracts with tour operators. So actually, that means in your but-for scenario, even with the pandemic, this hotel would have opened. In fact, it's been shut. And that means the damages on the claimant's view are actually going to be higher than they would have been had there been no pandemic, where the only difference would have been a sort of difference in the rates the hotel would have been able to charge.
Okay, just looking at the time, any final comments before I close?
I was going to reflect very quickly. People are smiling wryly at Alex's description of claimant's argument, but it does go to show, right, that things are complex, in today's world, and you need to think hard about what happened, and that's the challenge we will face, I guess.
Yeah, and the importance of instructions, in that sort of scenario, about what are we taking into account and what aren't we, what's part of the loss and what's not, I think will be really tricky and interesting going forward.
Okay, we are almost perfectly on time, so well done, panel members. So thank you all for your attendance, all of the attendees, and thanks again to Akika for hosting this event. If anybody has any follow-up questions or require one of our experts to assist you on any matters, please reach out to any of the panel members. You can find our contact information in the slides, which we will send out to all attendees. Thanks again.
Thank you. Bye.
Thanks very much. Bye-bye.
Thank you.